record without causing me trouble. Okay, looks like that seems to be working. Okay. And let me get into the class here just to point out a couple things. So when you submit your testing plan, if you have issues like Sharaha was talking about, that would be discussed, but make sure you're turning that in because that is going to be due here pretty quick. So you've got maybe another few days to turn that in, okay? Did everyone at least order their Becker material at this point?
Yes.
Is there anyone who hasn't received it?
I didn't.
I haven't received mine.
I haven't received it.
Okay, hang
Is
on.
there like an e-textbook with Becker? Or do you need like the physical book?
Hang on. I got to deal with these one at a time. If you've been in my class for some time, there's absolutely no reason that you shouldn't have received your material now.
Well, mine was a mailing issue because my address switched from Cali to Georgia.
Okay.
And
well,
I also
take care of
saw
that.
there's I saw they had a notification saying that they were like out of stock or on back order because of shipping crisis. So
Yeah.
it's in a first come, first serve.
Yeah.
Okay, first of all, please just limit the discussion to people who have not received their material. Who hasn't received their material?
I haven't,
I have not.
Me too.
but I have KPMG thing. Yeah.
I have not.
What does that mean, a KPMG thing?
So KPMG provides us the better material to study. I don't have the book, but I have it online, the book online and the classes, lectures.
Okay, let's go back over this, guys, because I think there's a problem. Okay, so what you do is you get an email from Becker, and when you get an email from Becker, the email will take you to a place where you click, and it's called Getting Started with Becker. You go to cpa.becker.com. You create an account. Were you able to do that? We talked about this last time. Okay, I'm going to assume that that means yes, that everyone did that. And then you went and you signed in, and I can't show you here because I already redeemed my books. But down in this area, there will be something that will say redeem. Is there anyone who hasn't done that? Okay, so everyone has done that. Is there anyone who did that more than, less than, let's see, more than 2 weeks ago and has not received their book? Is it more than or less than? Less than 2 weeks ago and has not received their book.
I did it less than 2 weeks ago and have not received anything.
I did it last week.
I think I want to ask, I'm asking the question wrong. More than 2 weeks ago. Okay.
I never got that email, welcome to Becker thing when I look at my college email.
If you're going through KPMG, handle it through KPMG. I don't know what to tell you. Okay, that's not that. If you already had access to the material, you need to handle that through KPMG. That's not a Becker thing. We'll deal with the other question about my ability to access your homework. But in terms of ordering your books and that, I don't know what you're doing. Whatever you did, you should have been able to order that. That's not a GGU issue.
But along with this class, shouldn't I get access to Becker through GGU?
No. You just told me you got it through KPMG. You just
Okay.
told me that you got Becker through KPMG.
Yeah, let's discuss this thing later, what I'm thinking. So yeah, that's
Okay. Yeah, let's discuss it later. Okay, so everyone else who hasn't got their book, you ordered it a short time ago. Is that correct?
Yes.
Yes.
Okay. So since you ordered it a short time ago, it should be coming fairly shortly. Okay. Now, the couple of folks, Trang and Cornelius, Trang, why haven't you received your book? Trang,
Oh,
why
Uh,
haven't you received your book?
oh, I think I just ordered 2 days ago, so I didn't get the textbook like normal things. But I order another one regulation, and it took me like 3 or 4 weeks to get a textbook.
You never got the BEC book either, though.
No, BAC I
We
got.
went through the, well, we went to the end of the class and you were asking me to post the BEC books because you said that you hadn't gotten yours yet at the end of the class.
Oh, I just
Okay.
want the
All
rest
right.
of the
All
18.
right. So you should be getting it pretty soon. Cornelius, what's the issue?
Yeah, mine was a mailing issue. I took care of it already. It should be here in a couple of days.
Okay. Okay, good. So anyway, with all of that, it sounds like we have a resolution of everyone's situation. It should be coming shortly. In the meantime, okay, what you do is you can get the PDF right here. You can also access an electronic version of the book through your software, okay? Whatever works better for you. I'm advising that you have the hard copy of the book or print that PDF or have a tablet version of the book somewhere so you can mark up the book as you go along. That's why I'm making this point. I'm going to be marking up the book and you should be marking up the book as you go along. So I'm going to open this PDF. You should have that PDF available and you should be marking the book up as you go along. Question on that?
How can we download the textbook from the software?
How can you access the book from the software, you say?
Yeah, I tried to look at it.
I believe somebody may need to help me with this because I don't generally access the book through software. Would it be here?
It's within the lecture.
Oh yeah, it's on the lecture section.
Okay, so I have to close this and what, go to lecture in F1?
Yeah. Yes.
Yes, that's it. You just click one of those and it take you to the chapters.
But can you mark those up?
No, Mark.
You can't mark them up, right? So you need the PDF, guys. You need that PDF that I posted on a tablet or something. So seeing the textbook in Becker doesn't help you because I need you to mark it up the way I'm not going by their script. I'm doing my own thing. And so
Yeah, you can make highlights
on
on it and add notes on the
lecture.
lecture.
That's not my notes. I'm God. You mark it up the way I tell you to, not the way they tell you to.
That's what I'm saying. We can follow along and mark it up
I got
the way
you.
you do it through it.
Yeah, I got you.
I thought you just told me 2 minutes ago you couldn't do that. Am I missing something?
Oh, I didn't say that. Somebody else you was talking to said that.
Oh, okay. So you can mark it up in here
Correct.
as you go along on their version. Hello?
Correct.
Oh, okay. Well, if that's the case, that's what I thought. If you can mark it up, so what do? You hit start here and then what? They let you mark it up the way I am somewhere here?
Yeah, if you click on it, there's a little thing that says highlight, add note, whatever. I
I
mean,
see. Okay.
if
So
you
could
click
do
in
it
the
that-
text, if you click in the text on something like, say you want to click on the word SEC, it'll say highlight. You have a choice, highlight, add note, or search.
Okay. Okay, so if you know how to do that, guys, that's fine. You can do it that way. That's fine too. Okay, I see. Okay, fine. Question? Okay, I think frankly, the best way is to order your book, have your book, mark it up that way. There's always this kind of, I don't know, I feel like there's this resistance to ordering the book and marking up the book because the logic in your mind is, I'm not going to mark up the book because then I'll have the book and I can sell the book to somebody else or something. If you're thinking that, stop thinking that. Mark the book up, tear up the book. I mean, look at my books are a mess. Okay, mark up the book. The book does more use for you if you're sitting there using it as a tool as opposed to something you're trying to keep pristine. Okay, so order the book, or you could go ahead and you could get those, you know, PDFs and print those, mark them up, and then eventually when your book comes in, you'll have that. Okay. All right, good. Okay, so with all that, thanks for your help on that. Let's go ahead and let's get started. And now we get the big test of the night, is to see what happens when I put my computer into tablet mode, because it has been throwing a fit when I do that for some strange reason. Let's see. Okay, nothing blew up, I guess. So let's go ahead and get started with F1. Okay, now when we look at F1 here, and for some reason I don't know why the update to Zoom made the Zoom bar big and in the way. Okay, anybody know how to hide the Zoom bar? Hide floating meeting controls. Okay, that might work, but then how do you bring them back? If you hide the meeting controls, how do you bring them back? Now I've done it. Yeah. Now how do I bring the meeting controls back?
I'm trying to look on my screen to see if I can help figure it out, but I don't see it yet.
Okay, thanks, Betsy.
What are you trying to hide?
I hid. What are you trying to hide, man? I tried to hide the meeting controls. I did hide them. Now I can't get them back.
Maybe click escape.
Thank you. So get for being too smart. Make the meeting controls a disaster that I was able to avoid last time. Guys. Okay, all right, so let's go ahead and I'll just deal with this ridiculously in the way meeting control. And let's just go ahead and take a look at F1, okay? And we're gonna spend a little bit of time here at the beginning, basically looking through some of the standards and conceptual framework. That's fairly light, okay? That's about 2 points on the exam, 2 to 3 points. Don't expect a lot of material there, and we're gonna just spend a little bit of time And I'm going to talk to you a little bit about your expectation for your research question on the exam and how that would be relevant there. But in terms of direct multiple choice questions in this area, you might have 2 or 3 points. Okay, and we'll make a couple of flashcards. Income statement, and really we're talking about the structure of the income statement. That tends to be fairly light, about 5 points. I don't mention the balance sheet there at all because we're going to get to the balance sheet and have a full discussion about the balance sheet items as we go through the different lectures, starting with F3. We'll start with assets. F4, we'll talk a little bit about consolidation. F5, liabilities. We'll start getting to the balance sheet as we move through the course here, okay? The big topic for tonight's class is going to be revenue recognition. Revenue recognition is a 10-point area on the exam. So that means you're going to get a fair number of multiple choice questions. That means that you can expect task-based simulation on revenue recognition, okay? And we talked last time about the way the exam is structured and the fact that they'll have a task-based simulation in the testlets 3, 4, and 5. You get 2 task-based simulation in testlet 3. You get 3 task-based simulation in testlets 4 and 5. And we talked about that structure last time. So when I put a 10-point area, that means expect multiple choice questions, a good chunk of them, expect a task-based simulation in that area, okay? Income statement, discontinued operations. There's a de-emphasis on this now, but you might get 2 or 3 points. Fairly simple stuff. We'll most likely get to that. We may get to that tonight. We may get to that next time, okay? Accounting changes and error correction. This has long been an area on the exam where you could expect 5 points, okay? And they expect you to know how to correct errors. Could be 5 to 10 points, okay? As a CPA, they expect you to be able to fix financial statements. You're the doctor of financial statements. If financial statements are sick, meaning there's errors, they need corrections, they expect you, CPA, to be able to correct those. So you can expect 5 to 10 points there. Comprehensive income, they might ask you, 2 to 3 points there. Not a real heavy area, but something we'll talk about next time. And then the adjusting journal entries, we'll look at that very quickly next time. That is just simply saying, hey, if you have an error correction, how would you adjust that through the journal entry? So that's really part and parcel to the error correction. Okay, all right, so let's go ahead and let's start to take a look here at our standards, okay? And you start taking a look here and they start talking about standard setting bodies in the United States, okay? And they mention the Security Exchange Commission. They mention the Financial Accounting Standards Board. You say, well, what about these other entities? Well, these other entities that they talk about here are really predecessors to the FASB. So back in 1933, 34, when they passed the securities laws, created the SEC, the idea was, in fact, if you look at the legislation, the SEC has the legal authority to set accounting standards. So SEC is really the entity that has the legal authority to set accounting standards. But they turned to the profession and they said, profession, you set the standards. So they first turned to the AICPA, and the AICPA, the American Institute of Certified Public Accountants, the American Institute of Certified Public Accountants, had the Committee on Accounting Procedure and the Accounting Principles Board as the entities that set standards for many, many years. Around the early 70s, around 72, 73, they looked at that and said, we need to remove the standard setting process from the AICPA because CPAs are funded by the AICPA funds the CPAs. And if they're setting, CPAs fund the AICPA, and the CPAs are funded by their clients. So in effect, the clients are setting the accounting standards. So they created a separate entity, the Financial Accounting Standards Board, and that entity is the current standard setter, and they have been the standard setter since 1973. Okay, so they're the current standard setter. However, the SEC continues to set standards in some cases. Okay, so what the SEC does is they weigh in on very specific issues that they still want to see entities do, and so they issue those in these different sorts of regulatory issues that public companies would have to follow. Okay. Now, if you look at some of the predecessors to the FASB and you look at their standards, in some cases, those standards are still relevant. So in other words, when FASB came in, they didn't say, well, forget everything that the CAP and the APB did. Some of those things they adopted, and then they have built on and amended from there. Okay. So what they finally did, because you had standards coming in from SEC, standards from the FASB predecessor, you have these different things that come from the FASB. They took all of these things and they put them in a codification. And now they call that codification the statement on financial accounting, not the statement on financial accounting concepts, but they call this statement the codification of accounting standards. Okay, right here, accounting standards codification is the phrase I'm looking for. And that's where all of these different standards reside. Okay, and that's been the case since 2009. So now you look things up by topic. So if you want to understand something about, say, the statement of cash flows, you go to accounting standards codification and you would go to topic 230. Okay, and in 230, you would then go to a particular section, say section 10, and then you go to a paragraph, say paragraph 30, and that's how you would look up a standard now. So instead of having to go all over the place and, you know, trying to find in chronological order how they issue these standards, you now go by topic. Okay, so just quickly to take a look at your software. Okay, let's just take a quick look at your Becker software one more time. I guess I have to reopen that. I have to go that way, but that's all right. Okay, and just look at F1 for a second. The homework for F1. And again, these are done by module. Okay, let's just look at module 2. Let's look at the simulation for a second. Okay, and this is asking you to basically prepare the income statement. So just showing you the way a simulation would work. Okay, but I'm looking for one that is specific to research. We don't want that one. Typically, we have at least one question where we ask you to do some research. This one has 2 tasks. Let's see.
I think Sim 3 and Module 2 might be what you're looking for when it's just looking in the standards.
Sim 2 and Module 2, you say?
Yeah, F1, Module 2, Sims, and then Sim 3.
Number 2?
Number 3, I think.
Number 3. Thank you. Okay, good. So when you look at how you would structure your answer, you can see here that you would go ahead and you would type in the topic, type in the section, type in the paragraph, and then the subparagraph that's related to that. Okay. Now, the beauty of this is when you do this, you don't have to have the thing memorized. You'd simply do a keyword search, and that would allow you to then search through the standards and find the particular thing that you're interested in. So the important thing is that you are practicing with this. So you would have to go over to the authoritative literature here and do a keyword search of the different things. You'd be interested in the FASB codification view, and then you can do a search. And so you do need to be practicing with that. They also have a little skill master video, I guess, if you wanted to watch that. But the best thing is for you to be practicing with this so that you can kind of see the way you would format your answer. Okay, it's topic, section, paragraph, subparagraph. Okay, so bottom line here is, from now our discussion here, yeah, I do want you to understand the different standards that constitute the codification. Do you have to memorize everything that's in the codification? No, you just simply need to practice doing any research on the different standards, and then that will, suffice you on the exam. Because of those, you get, 8 task-based simulation. You can expect at least one research task-based simulation, at least one. Sometimes you see 2. I suspect that if you see 2, that means that maybe one of those is a pre-test question that they're not going to count against you, but you don't know that for sure. So you have to do a good job with these research, and the way you practice is by looking at those research items that are in your task-based simulation. Question? Okay, good. Let's go ahead then and come back, and let's take a look at the conceptual framework for financial reporting. Okay, now, when we look at the conceptual framework, what this is something that FASB came up with when FASB was created back in '73. They were created, and one of the things that had been the criticism of the FASB's predecessors was that they seemed to go from topic to topic without a conceptual framework. So one of the first things FASB did was come up with a conceptual framework. And there have been various chapters, but they recently, I say recently, a few years back, put everything that's relevant to us in one chapter, in chapter 8. Okay. Now, one of the things that they talked about there is this concept of primary users. Okay. Primary users are investors and creditors. So what does that mean? You can flashcard that. These are primary users, investors and creditors. What does that mean? When I say FC, that means flashcard. That means that you should write a question on the blank side, put the answer on the line side. So on the blank side, you should get yourself a set of 3x5 cards. On the blank side, you should put what are the primary users of financial reporting according to the FASB conceptual framework. The line, put that on the blank side. On the line side, investors and creditors are primary users. Okay, now, you have, as part of your material that you acquired when you joined the class, pre-made flashcards. So if you see a flashcard that is in the same line of what I'm talking about, you don't have to make a separate one. But I do want you to have a set of flashcards that pretty much follow what I'm suggesting as flashcards for you. If you look and you have one in the pre-made flashcards that are electronically available, fine, you don't have to make a new one. But if you look and you say, I really don't see anything that captures this, then it's important that you make that flashcard. You make it the old-fashioned way. Get yourself a 3x5 card, write the question on the blank side, write the answer on the line side. Okay, so potential investors and creditors are our primary users. So what this means is when the FASB is issuing a new standard, okay, who are they thinking about? They're thinking about what? They're thinking about investors and creditors as their primary users. That doesn't mean that there aren't other users of the financial statements, but these other users, I don't know, the IRS, government entities, whatnot, are not considered primary users. They are secondary users. FASB thinks about primary users when they're issuing a new standard. Okay. Now, when FASB looks and they start to decide, well, what information should we require in the financial statements? Okay, they want to include information that is relevant, and they want to include information that will have faithful representation. Okay, because there's a lot of things that FASB could require companies to put in the financial statements, but look, they can't, sit there and pick everything. So when they're trying to decide whether something should be included in the financial statements, they look to see if that information is relevant. Well, what makes information relevant? Well, it is relevant if it has predictive value, tells you something about what's going to happen, right? Has confirmatory value, gives you reflection of what happened last year, and is material. Material meaning here, because a lot of times when we talk about materiality, you think it's a certain dollar amount, and it is if you're talking about auditing, but materiality here meaning that that fact is important enough to affect the decision of who are primary users, investors, and creditors. Okay, so flashcard, the ingredients of relevance. Now, faithful representation means that what? You can rely on that information. Well, what makes something have faithful representation? It is complete, it is neutral, and it is free from error. Okay, now just think about that for a second. You have, somebody that you really care about, and you want them to be faithful, right? So what happens? If you ask them, hey, how come you came home late? You expect them to give you a complete answer, don't you? You don't expect them to say, oh, well, I worked late. And they worked late. Yeah, they were supposed to get off at 5. They didn't get off till 5:05, but then at 5:05, they ran into their buddy and they went to the bar all night. Okay, that was not a complete answer, so they were not giving you faithful representation, right? So you want to flashcard these different elements, these different ingredients that make up relevance, make up faithful representation. Let me ask you a question. Do either of these things that fundamental qualitative characteristics, relevance, and faithful representation, do any of them share ingredients? Do either of them share ingredients?
Perhaps completeness and materiality in a way.
Okay, so I'm going to disagree and say no. Okay, they are different elements that make up, different ingredients that make up these. And the reason I ask that, Matt, is the way I see questions, they'll ask you, which of the following is an ingredient of relevance? Which is the following is an ingredient of faithful representation? And if they give you that question, you know that you're not going to have what? A yes on that, because they each contain what? Different elements, don't they?
Yes, I was reaching.
Okay. Okay, good. No, that's good. Okay, good. Now let's go ahead and let's take a look quickly at enhancing qualitative characteristics. Okay, so we've got our qualitative, our primary qualitative characteristics, fundamental ones, but there's also some that are enhancing. Okay, and let's just go ahead. Why not? Let's flashcard the enhancing ones. Comparability. Comparability means that we're going to want to compare what? Compare company to company. But we also want to be able to compare what? Period to
Time periods.
Yeah. So therefore, we talk about what? Consistency as part of the idea of comparability, right? Okay. Consistency meaning that a company shouldn't be, all over the road with their accounting standards. They should pretty much use the same standards between 2021 and 2022, et cetera, right? Now, does that mean that a company can never change their accounting standards?
No.
Does not mean that. Company can change their accounting standards. However, when they do, there will be bright lines of disclosure around the fact that they have changed their accounting standards. And we'll talk about that next time towards the end of this chapter what that looks like under the concept of accounting changes, change in accounting principle. Verifiability is really the audit process. Timeliness means what? Hey, the financial statements have to be in the hands of investors and creditors soon enough to be relevant to their decisions. So even though it's an enhancing characteristic, it gets back to relevance. It has to be what? It has to be timely. So that's why, you know, financial reports have to be out 30, 60, 75 days after year end, maybe 90 days. You start getting much more outside of that, and then the information is no longer timely. Understandability basically is getting into the disclosure aspect. So what happens? We have footnotes that go along with our financial statements. So we just don't whiz a bunch of numbers at you. We give you footnotes that help make those financial statements more understandable. Okay. All right, good guys. So I want you to flashcard the primary and the enhancing qualitative characteristics of information. Okay. Now you come over and you take a look at the objective of financial statements. Okay. And notice, guys, they start giving us a lot of information about the information being useful. Okay, so you come down right here. Useful, useful, useful. Okay, so look, you're looking for information that's going to help what? Users of the financial statements. And you look at this and you think to yourself, well, okay, you know, why is this so important, even for non-business, business organizations, useful to users? We've known that for a long time, John. Well, when FASB came into being and started to create these concept statements, you know, the idea that users were the focus was something that was a little bit novel at the time. So there may still be a question or two for the examiners think it's worth it to make sure that you know that we're preparing information that is useful for investor and credit investors investing in credit making decisions. Okay. All right, good. So let's just come down, and some of this stuff goes on a bit, guys. And if you've gotten this far, I think you know what assets and liabilities are. Okay, so I just want to go ahead and jump us to our first multiple choice question here, which is the bottom of page 11 here. Now I'm going to try the poll. I've been having trouble with it, and I still am. Okay, and I keep asking over and over again, can somebody help me with this problem with the poll? And it goes into a black hole, and I can't seem to get an answer. So let's just go ahead, and I'll give you a couple minutes to look at this question and then see what you think about question number 1 here.
I'm sorry, did you say you are trying to put the poll up for us? Because I'm not seeing.
I can't, and I'm going to send an email here.
Okay, got you.
Okay. Need more time? No, you're good. Okay, so what do you think?
I guess C.
B.
E.
Okay, D is the correct answer, and that what? You look at the ingredient of completeness, Okay, and completeness had to do with what? Faithful representation, right? You want your person that you're, you know, in love with or whatever to give you all of the information, don't you? You don't want them to give you half story, right? You want them to give you complete to show that they're faithful. And then, as I said, there is no ingredient that is shared across the fundamental characteristics of the accounting information, right?
I think the thing that's tricky is that the definition of materiality, which is part of relevance, says that if an omission or misstatement of the information could affect decisions. And that's when I first looked at this, that's where I was thinking, but then I thought, no, you got to simplify.
Yeah, I mean, I think we were pretty clear that, you know, there's the ingredients are very specific to the primary fundamental characteristics.
Exactly.
Okay, good. All right, let's go ahead and let's take a look at our income statement now. Okay, so we're going to be hovering around the income statement quite a bit now for the next, you know, couple of, well, today and maybe a little bit more next time we meet. And really, for our first couple of classes, we're hovering around the income statement. We will get to the balance sheet, but that really starts to get into when we start talking about assets and liabilities and whatnot. So we're really focusing on the income statement, okay? And we start looking at some terminology, and some of this terminology is so basic that I don't want to spend a lot of time with it, but I do want to come down and talk about revenues and expenses versus gains and losses, okay? And so when you look at revenue and expenses, okay, why don't you just go ahead and make a flashcard about revenue and expenses and put down here that these are normal course of bus. I don't mean, you know, the A93 bus that goes down Mission Street or something. I mean, normal course of business, normal course of business. They are operating items. Okay, and they are reported at what? They are reported at their gross amounts. Okay, they're reported at their gross amounts. Okay, and you can go ahead and flashcard all that. Revenues and expenses are normal course of business items. They're reported at their gross amounts. Okay, so what happens? You sit here and you think about paying for your materials for the CPA review class, right? So what happens? That's a revenue to Becker because what? That's their business, is selling review course, right? So it's a normal course of business and they're going to report that. If they prepared their financial statement, then they would show as expense what? The cost of the books, the cost of the authors, etc. So they report revenue and expenses. They report them gross on the financial statements, okay? Now, gains and losses are, and you can go ahead and flashcard this, okay? And they are not in the ordinary course of business, okay? They are non-operating items. And they are reported net. Okay, so what happens here? Let's say you go to Nordstrom and you buy a pair of shoes. Okay, if you buy a pair of shoes from Nordstrom, would they consider that a revenue? Yeah, okay, that's their normal course of business. The person that helped you out with the shoes, the salesperson, That's going to be expense. That's a normal course of business. Okay. Now, is it possible that Nordstrom would sell their cash registers?
No.
No.
No, what are they going to do? Throw them into the street if they want
Yes.
to get rid of them?
When they're retiring them.
Yeah, when they get new fangled cash registers, right? I mean, I think you
When they
said
upgrade.
no because you're saying, well, they won't sell me a cash register, right? You don't go up to the counter and the person says, hey, those are beautiful shoes. Would you like a cash register with that, sir? You know, they're not going to do that, right? So it's not in the normal course of business, but they could go and they could sell their cash registers to a cash register equipment dealer of some sort, right? And when they sell them, maybe they have to pay that person a certain commission to take them off their hands, right? So when they report that, what? They resell it for more than its book value. When we report that gain, they would report that gain net of any related costs that they had to pay, like a commission to the cash register dealer or whatever. They would report that net, right? Okay. Now, let's say they have some situation where there's an accident and one of their trucks backs into their store window or something and smashes that. Okay. Is Nordstrom in the business of getting their window smashed? No. So that's not a normal course of business, but they may have some insurance coverage that would cover for that accident. So they would report what? That loss, and they would report that loss net of any related costs. Okay. So revenues, expenses, report those gross. Those are normal course of business items, right? Okay. Those are operating items. Gains and losses, we report what? Separately, we report those as non-operating items because they're not the normal course of business. And we report them net of any related costs associated with that or any recoveries if we're talking about a loss. Okay. Question. Okay, good.
Yes, I do have a question.
Uh-huh.
What is really considered ordinary? Because, for example, if you've got a company that does a lot of foreign exchange transactions, I think they're typically netting those, but it's the ordinary course of business. So, and I mean, that would be an example of something that's ordinary, but you're presenting it net. I mean, that's how I typically see it on financial statements. And so I guess, are there any rules around what's ordinary? Or does it have to do with whether or not it's their principal business, like the main thing that they do?
Normal course of business, I don't know about ordinary. I wouldn't use that word ordinary, but normal course of business is something that, you know, happens on a day-to-day basis for an entity. So when you're saying they're reporting that net, you know, we're kind of asking a specific question with a vague notion of what it was that you saw. So, you know, we need to, you'd have to give me a specific example, you know, what you're talking about for me to be able to really answer that, as to why they're showing that net. But the big picture here is revenue expenses would be more day-to-day things. Gains and losses are things that are not going to be day-to-day. But there may be some other netting rules that might come in for a specific kind of transaction that might be beyond the scope of what we're talking about here.
Okay, I was thinking of foreign exchange transactions, that's all. But, you know, like foreign currency translation.
Yeah, that's not specific enough. So if you want to show me at another time specifically what you're talking about, we can look at that. Okay. All right, good. So flashcard that. Okay. And then I want to look at how that will translate into the multiple step income statement. Okay. So let's just go ahead and let's do this. There's two types of format for the income statement. One is multiple step, but I'm going to go past that. And I'm going to take a look at single step. Okay, let's start with the single step. So scroll forward a little bit, turn forward a little bit in your book, and let's look at single step income statement. Okay, and when you look at the single step income statement, notice what they do is they take all of the revenues and other items, and you can put a big plus there. Okay, all the things that increase net income, they report in one place. And then you can put a big minus down here, okay? All the things that do what? That decrease net income, they put that in one chunk. And then they go ahead and they report their net income. Okay, and in this example, the net income is 25, whatever, and they have reported that there. Okay, now, when you look at the multiple step, okay, and single step might be something that you might see in a disclosure somewhere, okay, and we don't need to get into all the details. They give you all the details first, and then they show you the statement, but let's just look at the multiple step, and let's just start at the bottom. And the net income is what? Net income is 25, isn't it? So the net income, does it change from the single step to the multiple step? It does not. What changes is the way the information is presented. Okay, now when you take a look, and notice, guys, they start with net sales, and don't confuse that with the netting process. Net sales is what? Revenues minus sales and returns minus discounts. And often companies will just start with the net sales, and that's perfectly acceptable for a company to start with that. And then they might disclose some information about returns and whatnot. Okay, but we come down and we start with our net sales. We come all the way down to income from operations. Okay, and I want you to go ahead and put down and label that as operating items. Okay, it says operating items. Okay, there's our operating items. Then you start coming over here. Notice they call that income from continuing operations. Then you come down here and you have what? You have other revenues and gains, and they keep coming down, and they have all the way down to income before income tax. These are non-operating items. Now, again, you start to look at some of these and, you can say, well, wait a minute, I saw interest revenue, and I saw it as an operating item. Well, you're probably looking at a financial institution. And for a financial institution, yeah, interest revenue, interest expense probably would be an operating item because that's something that they do every day, okay? On the CPA exam, far part of the exam, we're primarily talking about retail entities, and we're not getting into, the specific requirements of, financial institution or something like that, okay? So you have these two major sections. You have what? Operating items, non-operating items, and then you have what? You have the tax. Now, this example probably tries to do too much, and that they start talking about discontinued operations. And we're going to get into that later. If a company has a discontinued operation, they'll have to separate that out. But not every entity has a discontinued operation. Okay, so the general format that we see for a income statement is going to be what? Operating items, non-operating items, and tax. Operating items, non-operating items, tax. Operating items, day-to-day things, we report those gross. Non-operating items like gain on sale of equipment, we report those what? Net. And then you have your tax, which is reported, and then you have your net income. And don't worry right now about discontinued operations. We're going to get to that much later. Okay, question. Flashcard this income statement. Mark it up the way I've asked you to. And this is, again, guys, why I keep saying, hey, get your book, mark up your book. The way I'm telling you, when I say flashcard for something like this, now you got to do is go to your copier and make a flashcard size of this income statement and carry this little income statement around with you, because you're going to end up with questions on the exam in which they're going to expect you to understand how the income statement is arranged. Income statement is arranged what? operating items, revenue and expenses, non-operating items, gains and losses that are reported net, and then what? And then your tax is called out explicitly on there, isn't it? Okay. Question. All right, good. And we'll get into that discontinued operation stuff later. Don't worry about that now. Single step, again, single step tends to be presented as a, you know, maybe a disclosure or part of an MD&A or something like that, but just know the format of the single step. Okay, most companies, when you look at their income statement, you're going to see multiple step. Now, again, they mentioned balance sheet here just to be cute. I mean, we're not talking about the balance sheet tonight. It's income statement night, okay? In chapter 1 is all about the income statement, so don't worry too much here about balance sheet at this time. Okay, all right, good. Let's go ahead and let's start a couple questions. Take a look at a couple questions. I'll give you a couple minutes with question 1. Need more time for this first one? No? Okay, good. Scott Corporation sold a fixed asset used for operations for greater than its carrying amount. If you sell something for greater than its carrying amount, is that going to be a gain or a loss?
Gain.
Good. So it needs to be shown as a gain, and they're selling equipment that they use in their operations. When you sell equipment that you use in your operations, is that your normal course of business?
No.
No. Nordstrom isn't in the business of selling cash registers, in the business of selling shoes and pants and stuff, right? Okay, so this is going to be what? This is not going to be in the ordinary course of business. We're going to report this gain, right? Do you report gains gross?
No.
No.
No, you report gains net. So we know A is wrong. Now they give us a little challenge here because now we got to figure out B, C, or D. Net concept, okay, showing the total amount as a component of other comprehensive income.
No.
We had what? We had operating items, non-operating items, and then we had income from continuing operations, didn't we? Okay, and so that's not right. Net income showing the total gain as part of discontinued operations.
No.
Discontinued operation when you're getting rid of a whole segment of your business, not because you're selling one piece of equipment, right? Okay, so you come to D, which obviously is the right answer now. Net concept showing the total gain as part of continuing operations, right? And it's not net of tax because the tax had its own section down there, didn't it?
Right.
Okay.
Could you explain what that concept is again?
Yeah, net concept is if I sell my cash registers for $10,000. But the guy says, hey, look, you want me to take the cash registers, I'm buying them for 10 grand, but I'm going to charge you 1,500 if I got to come pick them up. And so you say, okay, I'll pay the 1,500 to come pick them up then. So really the guy is going to net you what, 8,500? Okay. And so, you know, if you sold them for, because I started with the 10,000, let's say they had a book value of 30,000, right? And and book value of say, how am I going to come up with this 10,000 being the gain? Book value of say 30,000. Okay, and you sold them for what? 40,000, right? You'd have what? A $10,000 gain. This is the cash you were going to get. But then the guy turned around and said, well, but you got to give me 1,500. So the gain net is what? 8,500 is the net gain. Who asked that?
If this was gross concept, then how would this show in the income statement?
If this was the gross concept, I would show on the income statement, I would show, I mean, it's a little bit hard because that's not how we present it. You're asking me, how would I present this on the income statement if it wasn't this transaction that I just described to you? I mean, the journal entry to record this would be a debit to cash of what, 8,500. It'd be a credit to equipment of 30,000. I mean, equipment, well, and I didn't give you the number here, but if the book value was 30,000, then it would be credit to equipment of say 50,000. And for it to have a book value, it'd have accumulated depreciation here of what? Of 20,000. And we'd have to be, never try to make up an example as you go along. The equipment was worth 50,000. Yeah, and then I had to get rid of the equipment. You gave me cash of 8,500 on this. No, how much cash did he give me? Yeah, he gave me 8,500 cash. Now I can't remember how much cash he gave me.
40,000.
Huh? Did he give me 40,000 cash?
Yeah, that's how you get the 10,000 gain.
Right. Okay. Right. 40,000 cash. Thank you. He gave me 40,000 cash. Now my pen's going to start to mess with me. He gave me 40,000 cash, and then we'd have the, but then he took 1,500, right? So the cash would not be 40,000. The cash would be, what's 40,000 minus
38,500.
38,500 would be the cash, and then I put the gain of 8,500, and that gain is what's reported on the income statement in the non-operating section, right? Net of any related costs. So you're asking me, how would I report it if I was doing it gross? Well, that's like asking me, how would I do it wrong if I was doing it? Now, if I had a revenue of say, 40,000, and then I incurred expenses in generating that revenue of, if you want to count the, cost of the equipment, the book value of the equipment is part of the cost, then my cost would be what, 31,500. And then I would report what, net income here, whatever, income from continuing operations of the 8,500, right? But that's not how we do it. We pick up, when we have something like this, you just pick up that gain, and that gain is what gets reported on the income statement, right?
Yes. So anything that goes under non-operating items are reported as that concept?
Net non-operating items like the gains and losses, they're reported net. And look, guys, when we talk about how things are reported on the financial statements, right? Financial statements are the result of journal entries. And this is something that I'm having trouble with my students these days is somebody has gone out there and hypnotized students that journal entries are not important. And so now students think that, financial statements magically appear, that the Terminator now creates financial statements. The Terminator comes and says, this will be a gain, and that's all we have to worry about. And then it comes out on the financial statements. Meanwhile, it's a set of journal entries that create financial statements, right? And journal entries are how we communicate what's going on with the transaction. And so this would be how you would record that transaction. The cash would be reported on the balance sheet. The equipment would come off of the balance sheet. The accumulated depreciation would come off of the balance sheet. The gain would go into the income statement, and gain would be closed out to retain earnings, so that the balance sheet balances at the end of this thing, right?
Yes.
Okay. So yeah, you do it this way when you make the journal entry, and that's what we're saying, that you report gains. What? You report them net on the income statement. The question is where on the incomes. The other question is where on the income statement. It's going to be in the non-operating section, right? But it's still part of continuing operations, because we take discontinued operations section, we call that out when we have an entire set of the company that gets eliminated. That's a whole nother subject. Okay. Okay, good. Which of the following should be included in general and administrative expenses? And guys, before we look at that question, I'm going to cheat a little bit. I'm going to go back to that income statement. Okay. And they're asking us here, let me make sure I got the question correct in my head. They're asking us here, which of the following is general and administrative? And let me ask you this, is general and administrative part of my operating items?
No.
Huh?
Yes.
No.
Yes.
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 General administrative is part of my operating items, right? I mean, I have to pay my salaries to my sales folks, right? Okay, commissions, whatever. I have to pay what? I have to pay my CEO, whatnot. That's not outside of the normal course of business, is it? Okay, so general and administrative items are operating items. Notice if we're not a bank, interest revenue, interest expense, right, is non-operating. Okay, you shouldn't be borrowing money to operate on a regular basis, right? It can happen now and again, but they're telling us, hey, for the most part, stick your interest down in the non-operating. Okay, so now you go back and you look at that question. We can work it together now, I think. You come back and you say, which of the following should be included in general and administrative expense? How about advertising?
No.
No, that's a what? Selling expense, isn't it?
Mhm.
Okay. How about interest? That's not even operating, right? And so
No.
the answer here is no, no.
D.
D.
Okay. All right. So make that flashcard of your income statement, guys, that I asked you to. Mark it up the way I did. Helps you with questions like that. When you have your flashcards, when you look at the how to study file like we did last time, I always tell you, look at your flashcards before you start working these questions. If you don't make the flashcards and look at them before you look at these questions, then you get into the questions and you're defeated already. You're saying, oh, I can't, I'm having real problems here. If you look at, you make and memorize the cards and then you work the questions, right? Towards the end of the week that we have, right? In the early part of the week, tomorrow, Saturday, Sunday, maybe Monday, you're finishing up the flashcards. Tuesday, Wednesday, you're getting in and you're trying out your memorized flashcards on this material. Then it's a positive reinforcing experience for you. It's not this, oh, I don't know what's going on thing. You're getting the questions right. If you miss some, add a couple flashcards that help you with the ones that you missed, right? Okay, and you're trying to get 75% before you leave this material. Now, once you get 75%, leave the material alone. Don't keep working the questions over and over. Leave them. You've got the flashcards that documented how you got to 75, all the key things you needed to know. You have those flashcards. Then you'll look at the flashcards again before you rework all of the multiple choice questions again in your homework as part of your final review. When you do the actual final review, and then you're going to look at those flashcards the last 2 or 3 days before your exam. You're going to look at the flashcards the day of the exam. You're going to take your flashcards with you to the exam site and do one more round with those flashcards before you walk into the test. And if you do that, questions like this are easy. If you don't do that, then you've got all this stuff bouncing around your head and you can't call it up quickly and you start running into problems with time and everything else. So you need to make those cards that'll help you with questions like this, to help a question like this stay as easy as it is now on the day of the exam. Okay, good. Looks like we're coming pretty much up on 6:30. I think that's a good breaking point. So what I want to do is take a break right now, and we will come back at, let's just make it an even number here, 6:40. I know we're a little ahead of that. It's not quite 6:30 yet, but we'll make it 6:40, okay? I'm gonna pause the recording. Matthew, you're up to remind me.
I got you.
Thank you. And let's go ahead and let's jump into some discussion of revenue recognition. So this is an area that is fairly heavy on the exam. I mean, I'm going to really need you to be comfortable with the things that we're going to talk about here. Now, they go through and they give us this 5-step approach to revenue recognition, and I'm going to ask you to flashcard these 5 steps, but I want to start with the idea that much of this formalized process of revenue recognition is things that we've been aware of for a long, long time as to what it is that generates revenue, what it is that would not constitute revenue. And so what these steps are really trying to do is formalize the thinking process that's been going on for a long time. So when we start to take a look at these steps, you know, just keep in mind that they really are, to a large extent, common sense, okay? So we have to identify, is there some sort of contract with the customer? In other words, has there been a meeting of the minds between the customer and the entity that would constitute a contract? And it doesn't have to be written, it could be a verbal contract as well, okay? Then we need to see, is there one or is there more than one performance obligation in the contract? And this really is where they started to try to get more into a formal thinking process, and that if there are more than one performance obligations, we're going to have to basically take that transaction price, that next step, and appropriate allocate it between the different performance obligations that are part of that contract price. So if you look at steps 3 and 4, they really are part and parcel of each other there. What is the transaction price? And then how do I allocate it to, and again, it doesn't have to be more than one performance obligation, but if there is, how do I allocate it to the, say, 2 or 3 different performance obligations? And then go ahead and recognize the revenue accordingly, okay? So flashcard those 5 steps, not because I need you to be looking at every single revenue recognition question and running through all 5 of those steps, more in the off chance that maybe you run into something that says which of the following would be one of the steps in revenue recognition, you can answer that question, okay? All right, so we come over and we start to look at the different steps, and they give us some examples here. And we start with step 1, identifying the contract. And again, a contract, guys, is really just a meeting of the minds. And so notice that we say that what? An entity can recognize revenue if the consideration is non-refundable and there's no remaining obligation, transfer goods or services. So what happens? if we have satisfied everything that we have to perform, we can recognize the revenue. We have a contract and we can recognize that revenue. Well, you look at that and say, well, I've known that for a long, long time. You study that in introductory to accounting. Hey, if you still have some performance that you have to perform on that contract, then that's not a revenue, that's a liability. Think of it in terms of something as simple of a television show that I like, Judge Judy. You know, you watch Judge Judy and the guy says, well, I paid the money, and then the guy never did the work. What does Judy say? Well, then you're going to give that money back to that guy, right? If you didn't perform on the contract, you said that you would do something for him, you didn't do it, you have to give money back. Well, if you have to give money back to people, we call that a liability. And I'm saying it funny like that, ability. Your bills mean that what? You're going to have to pay money to somebody, aren't you? Okay, so if somebody gives you money in anticipation of performing a service and you don't do it, well, that's a liability. Or you haven't done it yet, that's a liability. Okay, so let's just go ahead and let's take a look at this example of identifying the contract. And they tell us here that on March 1st, they entered into a contract. Okay, then we have a contract. I mean, identifying the contract, hello. The first few words of the sentence said they had a contract, okay? But let's take a look at the rest of this. To transfer a product to Kitty Inc. on September 1st, year 1. Kitty will pay the full contract price to Bulldog on August 1st, year 1. And the Bulldog transfer the product to Kitty on September 1st, year 1. Cost of the total product was $9,000. Now what happens? On March 1st, there's no entry because neither party has performed according to the contract, okay? But then what? By August 1st, this Kitty whatever did what? Gave $15,000. Now, you know, you've got to know journal entries to the extent that you have to know the difference between an asset, a liability, a revenue, expense, stockholders' equity. I mean, that's all the categories of accounts there are. Assets, liabilities, revenue, expenses, stockholders' equity. That's it. There's nothing else. Okay. And so what happens when you look at an asset, asset has future economic benefit. So you have to know to increase an asset, you debit it. And I don't know about you, my favorite asset is cash. My favorite asset is cash because I can turn it into any future economic benefit I want within the confines of the law, of course. So what happens? To increase the asset cash, I debit my cash $15,000 when I receive that money. And then I'm going to credit an unearned sales revenue. Unearned revenue, if it's unearned, it's a what? It's a liability, isn't it?
Yes.
Because I got to give that money back if the person doesn't, if I don't perform on the contract, I should say. So I credit the liability, unearned revenue, $15,000. Then what? Then a little bit later, I deliver the thing, I guess, on September 1st. Well, now I've performed on the contract. I can take the revenue. So I simply debit the unearned revenue to close that out. I credit the revenue for $15,000. And of course, I'd have to recognize the cost of that item. They cost $9,000. So I would debit my cost of goods sold. And I would report my inventory, or decrease my inventory by crediting it $9,000. It's an asset to decrease it. I'm going to credit it, of course. And so I have revenue of $15,000. I have cost of goods sold of what? $9,000. What's the difference between revenue and cost of goods sold?
Cost of expenses.
What?
It's expenses, cost of goods sold.
Gross income.
What's the difference
Gross profit.
between revenue and cost of goods sold?
Gross profit.
Gross profit here of what? Somebody help me with my math here. What is that? 6,000?
Yeah, 6.
Okay. I'm telling you guys, you look at this stuff and we give you a list of 5 steps and you think, oh my God, then you look at it, something what? This simple. That's it. You can't take the revenue until you perform on the contract. Okay. Now you could have what? You could have a situation in which you have more than one performance obligation. Okay. So what happens? There's a contract, but there's going to be a couple of things. Maybe I'm going to deliver the good and I'm going to provide a service with that. Right? Happens all the time. Companies sell product and they sell a service agreement along with that, right? Okay, so what happens there? Well, now we're going to have to sit there and treat each one of those as a distinctive item and use that to figure out how much of the total transaction price is going to go through one thing, say the product versus the service. Okay, so just come over and let's just take a look at this example, guys. And I rush you to the example because I feel like the book goes on and on about some of this stuff and starts to create this well of anxiety in you. And then you look at the example and you say, well, why didn't you just say that that's the kind of thing that we're doing? Okay, so let's just go and let's look at the example. Okay, and so you have a software developer enters into a contract with a customer to transfer a software license. That's one thing, transfer the software license. Perform installation. Well, that's a second thing there, isn't it? Right? You have the license. We're going to install the software. We're going to 3, provide software updates, and we're going to what? Give you tech support. So there's really 4 performance obligations, 1, 2, 3, 4 associated with this, and we're going to provide the tech support for 5 years. So you look and you have another element coming in here, which is what? There's certain parts of this that will be provided at one point in time, but there's another part of this contract that what will provide a service over a period of time, in this example, 5 years. Okay, so you come over and it tells to identify the performance obligations, and frankly I already did that right here. Okay, software license, installation services, software update, tech support. Okay, so I've got the 4 different pieces of this contract, and I'm going to have to allocate now whatever the transaction price is to those 4 different performance obligations that come under this contract. Okay, so the transaction price is pretty straightforward, guys. It's whatever they have agreed to provide. However, when you look, there could be a situation where you could have variable consideration. Okay, so the amount of variable consideration should be estimated by taking a range of possible amounts and using the expected value, which is going to be the sum of the probabilities associated with the different outcomes. So they may say, hey, if you do this, the price is that. If you do that, the price is this. And you don't know which of those outcomes is going to necessarily occur. You would simply sit there and provide a probability to each one of those events, each one of those prices, and then add those percentages that you've applied to each one of those, add those up. That creates an expected value, and that's the price that you would assign to that contract. Okay. Now you come over, and if we have significant financing, you do have to consider time value of money. Okay. And I'm going to show you that here in a second, an example of that in a second. You could have non-cash consideration. Maybe I'm going to provide a service in exchange for the product that they're giving me. Well, now it's going to be what? The fair value of the more readily determined item, either the service or the item that I'm acquiring. And then there could be consideration to a payable to a customer. Any consideration that's payable to customers should be treated as a reduction in the transaction price. So maybe I'm going to have to kick some money back. Okay, so go ahead, and I put the flashcard on that side for that one, but flashcard all 4 of these possible ways of considering the value of the contract. And then let's just look and make sure we're comfortable with time value of money consideration. Okay, so what happens? Let's just read this question, this example. So facts are January 1st, year 5, you sold furniture to customer for $4,000. and it says it's interest-free. Is there any such thing as an interest-free loan? No.
Nope.
Okay, not in the US anyway. Okay, and so what happens? So the customer took the furniture and now they have to pay this 4%, and they tell them, hey, 8% is the correct percentage to use for this thing. Now, what you would do is not the way they did this here. Okay, the way they did this here is the way somebody would do it if they were, very bored. Okay, what you would do is you would simply go to the present value of $1 table, and since it's 3 years, you would go to the 3-year row. You would find the 8% column. Okay, and most likely the exam would give you a small table of different things to choose from, but it's an 8% interest rate and it's a 3-year deal. And when you do, you get a present value of $1 factor, and the present dollar factor that resides in that intersection on the table, 3-year row 8% column, is 0.79383. And you're saying, well, how do you know that, John? Because I looked it up. I went to the present value of $1 table and I found that number. Okay, and I go ahead and I do what? I simply multiply then the 4,000 by that, and that gives me the present value of 3,175, and that would be the amount of revenue that I would recognize. Now you sit there and you say, but wait a minute now, they're going to actually pay 4,000 3 years from now. So what happens? Well, 3 years from now, I'm going to do what? I'm going to get that cash of 4,000. Okay, I would go ahead and by then I would have a receivable. Okay, and that receivable would be what? Would be for the full 4,000, because by then the receivable would have been increased each year by the amount of interest that I have earned on that initial, essentially a loan of $4,000, where I sat there and I took this. Now the actual revenue from the sale, not the interest revenue, the actual sales revenue is what? Sales revenue is equal to 3,175. The total interest revenue, and this isn't over 1 year, this is over the entire term of this contract. The total interest revenue is, what's 4,000 minus 3,175?
825.
Huh?
825.
825 would be what? Would be, and again, it's the total interest revenue. It's not just the interest revenue associated with any 1 year. That's over the entire period. So you take a look at this. In fact, they give me the interest revenue each year right here. So they showed us that, the way they got the interest revenue each year. But notice we have what? We have 2 performance things here. We're loaning money, we're earning interest there, and we're getting the revenue on the sale of this particular whatever it is, piece of furniture, whatever. And of course, they didn't talk about the cost of the furniture here. Question? Okay, good. Now we come over and we have to what? We have to allocate now to the various performance obligations here. And basically we kind of already did that a little bit in that example up there, just by understanding the time value of money. But let's just go ahead and see how we would allocate that. And often when we have various performance obligations in a contract, there would be an ability to basically tease out the standalone cost associated with each one of the performance obligations under that contract we would use that as our base to then allocate the total purchase price to each one of those performance obligations. Okay, and again, guys, when you look at this, I think your anxiety probably builds up, and then when you get to the example, you're like, that's it, that's all there is to it. Okay, so you come over and you look, and they have a contract, okay, for 250,000. Okay, now that 250 has to be allocated between the various performance obligations in this example. And we have what? We have the software license, we have the installation, and we have tech support. So this one only has 3. I forget, what was the thing on the other one?
Updates,
Huh?
updates.
Updates, and they left that out in this example. Okay, good. So this one only had 3, okay? And then they sit there and they tell me what each one of these would sell for separately. So the what? The license, I'm gonna try to strike that out. The license is what usually sold for 160. Installation is sold for 20, and tech support is sold for 30. So now you sit there and you say, well, okay, that's a total of what? 270. If you add those 3 up, 160 plus 20 plus 30 equals 270. 270 is my base, and then I simply allocate the portion of the total 250, or the portion of the 270, I probably should say, I allocate the 250 to each one of those products, right? Simple allocation. Now, what's interesting in this question is when you get to the journal entry, okay, so what happens? We've identified the different performance obligations, okay? We've allocated the price to the different performance obligations, but when we look at the performance obligations, we have to say, are they given at a point in time or over time? Okay, and the licensing revenue and the service revenue, yeah, that's going to be given what? At a particular point in time, but the what? The unearned service revenue is 83,333, because they told us that we're going to provide that what? They're going to provide that over a period of time. Okay, so what happens? You take a look, and they probably called that service revenue. They probably should have made that a little more clear by calling it installation service revenue, right? It's just for our purposes here. I mean, for financial reporting purposes, you might call it all service revenue, but for learning purposes, it would have been helpful for them to call that installation service revenue, okay? But there it is, you have that service revenue is given when you install, you give them the license, but the what? The tech support thing, that's going to be over what? They told us over how many years in the example?
36
That's going
months.
to be over how many? 36 months?
36 months, yeah.
Okay. I don't know where that was. I can't seem to find it now.
It says 3-year period, line 3 of the fact set paragraph.
Line 3, 1, 2, 3. Okay. Hello. You mean the thing I underlined? Okay, so it's a 3-year, so that's good. That's 36 months. And since it's what? They enter into this deal March 1st, right? That means that for that first year, we'll only take a portion of that complete year. So it's what? It's $314.80 per month. And for that first year, it's 10 months. Be careful, guys. Be careful with your months. I like to count on my fingers for months. March, April, May, June, July, August, September, October, November, December is 10 months. It is very easy to say, oh, okay, well, March is the 3rd month and there's 12 months in a year, so that's 9 months. We have to count March, don't we? Okay, so be careful with that. But we go ahead, and in that first year, we can take 23,148, and for the rest of the years, 2, 3, and I don't know why they're saying year 2, 3, and 4. Oh, I see, because a portion of it would be in year 4 because it's 36 months. And we
Yep,
signed
the
a
last
contract
2
in March.
months. Yeah.
Yeah, of March, the last 3 months would go in year 4. Yeah, we would go ahead and take the remainder. Okay. Question. Okay, good. Now you start to take a look at these things, guys, and you start to see, you know, that it really is a lot to do about common sense to a large extent. Okay, so here we talk about recognized revenue as we satisfy the performance obligation, and it could be satisfied in a point in time or over time. And we've already talked about this, to be honest with you, but let's just take a look. An entity should recognize revenue when the entity satisfies a performance obligation by transferring the good or service to the customer. Okay, so you transfer the good to the customer, you've performed, right? They've got control of that good. You've transferred all the risk rewards of the ownership of that asset. You can take that revenue. Okay, again, revenue should be recognized over time, and they give us the criteria for recognizing the revenue over time. And I'm going to go ahead and ask you to take a look at these. I'm not going to ask you to flashcard them, but let's just go ahead and take a look and say any one of these criteria would be met, you recognize over time. So the entity creates or enhances an asset that the customer controls. Okay, the customer receives and consumes the benefit of the entity's performance as the entity performs, such as a cleaning service. The entity's performance does not create an asset with alternative use of the entities, and the entity has the enforceable right to receive payment for performance completed to date. Okay, now when I think of this, I think of let's say somebody's doing work for your landscaping in your backyard. Okay, let's see, do you think the landscaper should recognize revenue over time as they plant things in your backyard and stuff? Do you think the entity performance creates or enhances an asset that the customer controls? Who controls your backyard? You do. The customer controls their backyard. The landscaper can't come and say, well, I'm taking your backyard away from you. Okay. The customer receives and consumes the benefit of the entity's performance as the entity performs. Okay, maybe not as obvious, but you know, if they sat there and they put your patio in and they're still working on the softscape, you can still sit on your patio, you can consume it, you've got the control of it. And what the entity, and it's any one of the criteria, and the entity's performance does not create an asset with an alternative use to the entity. The landscaper can't say, well, John didn't pay me for this, so go and, you know, sit in his backyard and have a good time because I put that patio in, whatever, right? Okay, so that would be an example where the contractor could recognize revenue over time, right, as they perform on that contract. Okay, now in order to recognize the revenue, the entity must be able to reasonably measure progress towards completion. Okay, well, how are they going to recognize progress towards completion? Well, they could use an input approach or an output approach. Okay, so output approach means what? Hey, how much have I actually transferred in terms of what was promised? Am I 50% done? Am I 60% done? You could use an input method. Hey, my total cost for putting in this fool's backyard is going to be, you know, 200,000, and so far I've put in 100,000 of that, so you could recognize half of that revenue. And that's really the approach that we use when we talk about percentage of completion method. And we'll probably just look at time, probably not going to get to that until next time. Okay, so these things would constitute recognizing revenue over time. And they say, hey, one way to do that is straight line, $75 per month as the service is provided. Again, I'm showing you these terminologies and whatnot so that you're comfortable with the way some of the CPA exam questions may talk to you about it. But what should be running in the back of your mind is what? common sense. What have I done? Have I performed in order to recognize the revenue? And if you haven't, then you can't recognize the revenue yet, right? If you have performed and you perform some things in total, take all the revenue at that point in time. If some of the things that you're going to perform are going to come over time, then you have to sit there and recognize that revenue over a period of years, months, whatever it is. Okay. Now, you could, of course, recognize the revenue at a point in time. And if the obligation is not satisfied over time, it is satisfied at a point in time, one or the other. Okay. And the revenue should be recognized when the entity controls the asset, and control would generally require the following. And let's go ahead, let's flashcard both those things just so that we're clear. It's either a point in time or over time. That's the two options we have. And then let's just take a look at what would constitute control. Okay, so the entity has a right to payment and the customer has an obligation to pay for an asset. The customer has legal title to the asset. Okay, the entity has transferred physical possession of the asset. The customer has the significant rewards and risk of ownership, and the customer has accepted the asset. Okay, now when I look at this, I look at it, you buy a house. And while they're building the house, say it's a new house, it's being built. While they're building the house, what happens? They sit there and you don't get the keys. They don't give you anything until what? Until the deal has completely closed, then they give you the keys and everything, right? And if that next day you come in and you say, well, look, there's this huge hole in the wall. Well, they're going to say, well, you put that hole there, right? Because now you have all the risk and rewards. That's why they make you do a walkthrough. Hey, what things do you see? And sure, they'll come back and fix a few nicks and dings that you might point out as time goes on, or if something isn't performing up to specifications and there's some sort of warranty, they may come back. But if you come back next day and the house is, burned down, they're not going to take responsibility for that because they've now transferred the ownership to you, right? The house burns down the night before you take ownership. That's on the builder, right? They lose. Okay. Okay, good. So flashcard that. And then let's go ahead and let's take a look at this notion of satisfied at a point in time, because we've talked about overtime a little bit, but let's go ahead and take a look at performance satisfied at point in time. Oh, you know what? Actually, let's look at both of these, over time and a point in time, but let me start with this. The reason I first thought I would skip this example and then I decided to go through it is and I wrote up here, annoying but good. And by that, this example is annoying because it's like, well, this is a weird thing that's going on here. And why wouldn't I satisfy this over time? Obligation, why wouldn't it be considered satisfied over time? It's all obvious that it's over time. That's the annoying part. But the good part about it is that it's written in a way that maybe could trick you into thinking that it's at a point in time when it's actually over time. Okay, so let's just go ahead and let's take a look at this Tanner company building a multi-residential complex. The entity enters into a contract with the customer for a specific unit that is under construction. The contract has the following term. The customers pay a non-refundable security deposit. Customer agrees to make progressive payments during construction. If the customer fails to make the progressive payments, the entity has the right to all of the consideration. So they're going to keep going and keep building, and they're going to say, you're taking this unit. We're not taking it. It's yours. We're going to finish the thing and we're going to sue you and you're going to pay us and it's yours. You figure it out. And probably what's happening is what? There's a certain amount of customization that must be going into this, that they're saying, well, we're going to do all that. Then there's going to be a contract that's going to say, you're going to pay us as we go. You're going to pay us regardless of whether, you end up wanting the thing at the end. You're going to have to pay us all. We're going to keep going and we're going to finish this thing. Okay. And the terms of the contract prevent the entity from directing it to another customer. So the contract says I can't sell it to anybody but you. Well, if that's the case, then I could go ahead and recognize the revenue as I perform under that contract, right? And maybe I'm using the input approach. My total cost on this condo is $1 million. So far, it's been 800,000, so I'm 80% done. Okay. Now, when you look at this other example where they're going to satisfy it at a point in time, now let's take a look at the fact customer pays deposit upon entering the contract that is refundable if the fail entity fails to complete. The remainder of the purchase price is due on the completion of the units. So you're really just giving them a deposit to what? To hold your interest on that, right? Now what happens? If the customer defaults on the contract, the entity only has the right to retain the deposit. They can't force you to buy that particular thing. And if you talk about real estate in the state of California, if I give a deposit and it's a builder, say for a home, and I give them the deposit, and then let's say I lose my income, and I say, hey, I can't buy that house now. What happens in the state of California is if they sell the house for equal to or more than the contract price, they have to give you your deposit back. There's no such thing as, well, we're going to keep your deposit and then we're also going to sell the house and get more, sell it for more. So now we're getting to keep your deposit and we're getting to sell the house to somebody else. Okay, so if it's something like that, then you can't recognize that revenue until what? Until you deliver the house, you give the person the keys, and they now have all the risks and rewards of ownership. Okay. Question? All right, good. Now, let's take a look and see how that's going to be presented on the financial statements. And this, to me, gets a little bit, I don't know. I look at this and I'm like, this is obviously a bunch of nerdy accountants, guys. I'm just going to give you that caution. Sitting around deciding how these things should be presented, whether they're in asset or liability accounts, to be honest with you. And so we're going to go ahead and have to make a couple flashcards on this. Okay, so this part, I can't really point to common sense. So we're going to have a contract asset or liability should be printed in the financial statements when the entity, either party has performed in a contract. Okay, so let's just go ahead and flashcard that we have a contract asset reflects the entity's right to consideration in exchange for goods or services that the entity has transferred to the customer. Okay, so but then they give us this note: if the payment due is conditional only by the passage of time, then we don't call it a contract asset, we call it a receivable. Okay, so this is a bit a nerdy accounting thing, but go ahead and flashcard that. Okay, a contract liability must be booked when an entity has an obligation to transfer goods or services to a customer, and we're calling it a contract liability, guys, and it's a fancy name for what? For unearned revenue, essentially. Okay, and we're calling it a contract liability because we performed on that, and so or we received some sort of asset and we haven't performed on that yet, then we're going to consider that a contract liability. Okay, now let's just go ahead and take a look at this and facts. Okay, and again, I think the examples help to illustrate pretty well what we're doing here. So Anderson Company enters into a non-cancelable contract with Tanner for the sale of an excavator for $350,000. The excavator will be delivered to Tanner on April 1st. The contract requires Tanner to pay $350,000 in advance on February 1st, and Tanner makes the payment on March 1st. Okay, so let's look at Anderson is the entity that's providing this excavator. And what happens? They have a receivable because we're simply waiting for what? We're waiting for the passage of time to when they will actually go ahead and pay that full amount. So if that's the case, then there's going to be a receivable for that, right? Okay, so February 1st, we set up a receivable. Look, your debits have to equal your credits. We're all in agreement there, right? Okay, and what happens? You're booking a receivable because they're going to pay you in a month, and it has nothing to do with the performance on the contract. They're simply going to pay you in a month before you've actually performed on the contract, haven't you? And so if they're saying that we're waiting for money simply because the passage of time, we call that the asset called receivable. You have to credit something, right?
Question on this. Why aren't we booking anything in January? Because January is when they actually sign the contract, and it's non-cancelable.
Because nobody has performed yet any of this requirements under the contract. So they have to start performing something under the term of the contract, right? Contract.
Okay.
And
So something has to happen on it before it triggers an accounting recognition, right?
Yeah, I mean, there's nothing really to account for until requirements under the contract start to come into play here, right? So there is no transaction that's occurred until somebody has to start performing, which is on February 1st. We get is when the excavator will be delivered, and Tanner has to pay $350,000 on February 1st. So we make a journal entry on February 1st, and I can't tell you why Tanner didn't pay on on February 1st, but they didn't pay until March 1st. What do you want me to do? Okay, so I have to do something. So I have to debit receivable, and now I'm just waiting for them to pay. The passage of time, I'm just waiting for them to pay, so it's receivable. Now, when I do the credit, my options would be to do what? I could credit, let's go through the options of credits. Can I credit another asset at this point? No.
No.
Can I credit a revenue at this point?
No.
No, because I haven't performed. Can I credit stockholders' equity?
No.
No.
No, so I've got to credit what? I'm only left with a liability. And it makes sense that it's a liability because what? I've still got to do something, don't I? If I told, if Anderson went and told Tanner, here, I'm not giving you no excavator, what's going to happen? Tanner's going to say, well, then I'm not going to give you any money. We got to get rid of the receivable because we don't have any future economic benefit or receivable. So we would reverse this journal entry if something weird like that happened. Okay, but they go ahead and on March 1st they pay. Okay, well, they give me cash at that point. I debit the cash, I credit the receivable. And then on April 1st, when I deliver the excavator, now I perform on the contract, I take the revenue. Okay, so again, guys, they're giving us nerdy accounting terms. Let's go back and look. Contract liability. I have a contract liability. That's a fancy word for unearned revenue. I had to set up an asset, and my choices on the asset are what? Are either contract asset or a receivable. And I call it a receivable if the only thing that I'm waiting for is the passage of time. I'm just sitting there waiting. Okay, you're supposed to pay me. Where's my money yet? And you want to record that somebody owes you some money because they were supposed to pay you February 1st. They didn't pay you until March for some reason. Well, just go ahead and take a receivable for that because they owe you the money, right? They're supposed to pay you. I mean, if Tanner had paid the cash on February 1st, then I would have debited cash and credited contract liability, and there'd be no mystery here, right? Okay, but since there was a passage of time between the time when they were supposed to pay me and when they paid me, I just set up a receivable. Okay, okay, good. Now you come over and let's see what happens where it's a contract asset. Okay, now we're waiting for payment for some other reason other than the simple passage of time. Okay, now if that's the case, and let's just read the facts here. On January 1st, Anderson Company entered into a contract for the sale of two excavators, $350 each. The contract requires that one excavator be delivered on February 1st and states that the payment for the delivery of the first excavator is conditional on the delivery of the second excavator. So it's not a simple passage of time. Hey, you're supposed to pay me February 1st. Where's my money? They don't get around to paying you January 1st. Now, in order for them to pay you for the first, you got to deliver the second. Okay. So what happens? Now we go ahead and we can take the revenue February 1st because what? We delivered the first excavator, didn't we? So we performed on the contract. Okay. But they're not going to pay us, not because of the passage of time now, but although time is going to pass, but that's not the critical factor. The factor is that they're waiting for the second excavator. So if that's the case, it's what? It's something other than the passage of time. It's called a contract asset. I promised nerdy accounting here before we went into this, didn't we? Am I delivering on my promise? Okay, it's nerdy accounting stuff. That's why we flashcarded it. I called it a contract asset, not a receivable. It was something other than the passage of time. And then what happens? I deliver the second excavator on June 1st. They haven't paid me yet, so I simply set up the receivable, credit the contract asset, credit revenue now for the second excavator. And then it would have been nice of them to kind of complete the thought when they finally pay me. I guess since the question didn't say when they actually paid, but say they pay me in July or say June 15th, I don't care. They pay me whenever it is they finally pay me, then I'm going to go ahead and I'm going to do what? Debit cash, 700,000 and credit the receivable, right? 700,000, just to sort of complete the thought that eventually we're going to get the cash. Because now I'm just waiting for the cash, right? So we put the whole thing in a receivable account. Question? Okay, let's review. Asset, liability, revenue are the counts that are involved here, right? Okay. We can't take the revenue until we perform on the contract. Very simple, very simple. Since we can't take the revenue, what's our credit? Got to be a liability, contract liability. It's unearned revenue. They're just calling it contract liability here. Okay. Okay, let's look at the asset side. They're either going to give me cash or what? They're going to give me cash later. If they're going to give me cash later and it's simply, I'm just waiting for them to pay me some cash that they're supposed to pay me, that's receivable. If what? If I'm sitting there and I have to perform something additional other than the passage of time, then I'm going to just record that and call it a contract asset. That's it. Okay.
Delivery of 2 rather than delivery of 1. I guess that's what's confusing to me a little bit because they haven't really earned the revenue until they delivered the second one.
Well, no, they took the revenue for the first one when they delivered the first one.
Okay.
Right? When they delivered the first one, I don't know why I drew the arrow down from there. It's 2 excavators. They delivered the first one. Right?
Mm-hmm.
So they took the revenue for the
Oh,
first
I
one.
see what it is. It just has to do with the timing of the payment. It's not, okay, I get it.
It wasn't a receivable, Kathy, because they had to deliver the second excavator in order to be entitled to receive the payment for the first.
Yeah, I was this is it. Who makes a contract like this? This is like a book of stupid contracts. Sorry.
Well, yeah,
Yeah.
it is to illustrate the point. I think, contracts can be as convoluted as necessary, right? And I'm thinking maybe something like this is, well, look, I need 2 excavators, dude. Don't leave me hanging with 1.
Yeah.
And then you tell me, okay, well, I can get you 1 in February, but I can't get you the other one till June. And I look at that and I say, well, that's okay, because I can function with that because I'm in the January, the weather's not as good. And so I don't really need 2 excavators right away in January. So, okay, I can live with that. But by June, MF, I need 2 excavators. If you can't give me the second excavator by June, we got a problem.
Got it. Okay.
And so we write up the contract that way. Now you may say, well, what are you going to do? You're going to use the excavator for, you know, that period of time. And then he doesn't give you the second one. So you give him a half-used excavator or something. And the answer would be, well, that would be the kinds of things that would be worked out in the contract, right? As to how we handle the situation. If you breach, then there may be some deal, well, then I have to take it back from you, or I don't know, whatever. But, you know, contracts can continue to be convoluted. The point is, okay, for CPA exam purposes now, is how we categorize. It's really about how we categorize that asset, isn't it? I mean, I think we understand the revenue point versus the liability. It's that, you know, asset. And if you're just waiting for them to pay, it's, you know, it's April 1st, it's March 1st, where's my money? You set up the receivable, probably so you can bill them. You set up the receivable, you credit the liability, you're waiting for that time to come, then they pay you, you know, March 1st, they say. It could have been February 15th that they pay them. That's when you go ahead and you set up the, you know, the receivable. But if you have to perform something, that asset is called a contract asset.
Got it. No, I was getting confused about the payment versus the delivery and the performance. That was my confusion, and I've got that sorted now.
Beautiful. Maybe that's how I should have said it to begin with. The payment is the passage of time thing versus the delivery of the service, right? Which is the contract asset part. Okay, good. Let's look at a couple questions, guys. Okay, so you look at a question like this, and you would think after all that, we'd have some, you know, interesting, you know, tough revenue recognition thing to consider. But they tell us that what? They pay $540 in advance. So they debit what? When you receive cash, you debit cash $540. And if you haven't performed on the contract yet, what do? What do you credit?
Unearned revenue.
You credit unearned revenue because we haven't done anything yet. If this bug spray company, you know, goes out of business or something and they can't perform the contract, they got to give the money back, don't they? Okay. All right, good. And so then what happens? Then we perform the service each month, and they tell me that the contract was for, what is it, for a year or something?
Mm-hmm.
Okay, so you pay an annual fee of $540. 540 divided by 12 equals what? Equals $45 per month.
Mm-hmm.
So as perform the service each month, I'll debit what? I'll debit the unearned for 45. I'll credit the revenue for 45. So it's what? Evenly over time as service is performed, right? Okay. All right, good. Let's go ahead and let's take a look at this one. And let me give you a quick hint on this one. And it's the same thing on all CPA exam questions where they ask you a journal entry and then they give you choices on half a journal entry. Is that your training? Were you ever trained to make a half a journal entry?
No.
No, you were trained to do what? Put a debit, put a credit, weren't you? Okay, so when the choices are half you debit or credit, you make the whole journal entry that represents the transaction, and then you get into the choices and see which one corresponds to the entire journal entry, right? Isn't that the way to do this?
Yep.
Okay, so go ahead and give this one a shot, guys, and I'll give you a little time with this one. Okay, guys, let's go through this one together, okay? And to see how we ended up, okay? You want a little more time with it, or are you ready to jump in?
Do it.
Ready? Okay. Okay, let's go ahead and look. Okay, on April 15th, year 3, Landing Company signed a contract that entailed providing a specialized piece of equipment for $215,000 to Jacob Inc., with delivery expected to occur on August 31st, year 3. For the terms of the contract, Jacob will pay London the full amount on July 31st, year 3. So when does a first performance end up on this contract?
July 31st?
7/31 is when somebody actually does something, right? Okay, so I go ahead and on July 31st, I debit cash. What is it? 215.
Mm-hmm.
And I credit, I mean, you can call it contract liability if you want. I like to call my contract liabilities where I'm supposed to deliver something unearned revenue. 215. That happens on July 31st, right? Now I'm doing this because I noticed in the question, they asked me about journal entries. And so I'm going to journalize everything I can here and then compare it to the choices, what they're asking me, right? So they tell me that Landon's cost to produce the equipment is $175,000. Assuming delivery occurs as expected on, something happens on 8/31, doesn't it?
Yes.
Okay. The August 31st journal entry for Landon would involve the following. Well, if I deliver the thing on 8/31, can I take the revenue?
Yes.
I already got the cash. So since I delivered the thing on 8/31, I can sit here and debit unearned revenue, 215, and credit revenue for 215, right? Because I've delivered the thing. But of course, I have to recognize my cost. So I have to debit what?
Cost of goods sold.
Cost of goods sold. Good. What is it? 175? And credit my inventory for 175. Okay, good. So the thing's asking me 8/31. So I'm going to look at these, you know, 2 journal entries, and I'm going to see which one corresponds. So did I credit cash?
No.
No.
No, I had credited cash. I received cash. Okay, that's nonsense. Do I debit inventory?
No.
I credit it. Do I credit cost of goods sold?
No.
I debit it. Yes. I earned the revenue at that point. So guys, when you look at these questions, you know, and you're going to see a bunch of them here as you complete module 3, they can be scary. I want you to take a deep breath when you look at these questions and realize that at the end of the day, they're putting a lot of terminology around things that you intuitively understand. And think about, hey, it's either going, there's going to be an asset involved, a liability involved, or a revenue involved. That's it. That's it. That's what I like about accounting is I can sit there and if I figure out half that, then I don't have to, you know, now I'm down to either a revenue or a liability. If we're talking about an asset, they're giving us 2 different types of asset, contract asset or receivable. It's receivable if it's passage of time. Okay, so at some point you start to get very comfortable with this stuff in terms of answering these questions that may seem a little daunting at this point. Okay.
Professor, I have a quick question. Is there any difference between revenue and sales account? Are they the same or are they different?
No, they are what's the word? Ostensibly the same. Okay. To me, revenue is generally associated with service. Sale is generally associated with delivery of product, but there's nothing written, you know, in stone that way. So I would say no, there is no difference.
Thank you.
Question?
How would we be tipped off to, I don't know how it would be asked, but to call it the contract liability as opposed to unearned revenue, which is our natural inclination?
They could not give you competing choices that say contract liability versus unearned revenue.
Okay, perfect. That
Same
makes
thing.
sense.
Yeah, I call it unearned revenue. You know, yeah.
Got you. I don't know why they would call it anything else. It doesn't make sense, but got you.
You know, I don't see the point in confusing users of financial statements with this idea of this notion of contract liability, because users of financial statements understand the notion of unearned revenue, and analysts look for that account. I mean, if you're looking at a company, do you have a frown on your face when you see unearned revenue or a smile?
Frown.
Smile. You got the cash.
Predictability to the cash flows.
Yeah, I'm happy. If I'm seeing unearned revenue, right? I could be looking at a company that say has a negative net income and liability on their financial statement called unearned revenue and a positive cash provided by operations. Because it's telling me, look, they've got now contracts that they've received some sort of consideration under, probably cash, that they're, booking, that asset for, and now they just have to perform on the contract. So maybe I'm a company that's been developing some sort of product or service, and it's taken me time to get up to that. And now I've got something that I can actually provide, and I'm going to start really generating net income off of that in future periods, right?
Yeah, that makes sense. I guess I was looking for them at the standpoint of there's a risk that for some reason they can't perform to that contract, therefore they would return that money. But I see where you're coming from.
Well, no. Hey, that's a good observation. So I would also, remember we said understandability. So it's not just the numbers on the financial statements, it's also footnote disclosure. And in footnote disclosure financial statements, they are required to talk about risks and uncertainties, right? And so there would be some discussion around that, Matthew, and you'd be looking very carefully at that. Further, in their SEC reports, in their 10K, there's a specific section called out risks and uncertainties, or risks, I forget what they call it, but whatever. There's a section in there, specific section called out, where again, discussions of this nature would be talked about. In my medical business class at Stanford, I required them to look at certain companies and see what the discussion was about risks in their 10K filings. And a common theme was, well, will insurance continue to pay for this? And what a lot of the companies called out was basically, everyone seemed to think that, it's Obamacare, let's get rid of it. Oh, sorry, we don't call Obamacare, we're going to change it, we want to change it. Well, you're causing uncertainty in the market, in business, by doing that. When you keep flip-flopping on your policy as a country, you start to create situations where, people don't know what's going to happen. Jesus, this thing covered or not? And I'm a company like Abbott. I'm putting all my energies into developing a thing that you can just stick on your arm and tell you if you're gonna need a kidney transplant. Meanwhile, I don't know if the insurance is gonna cover the freaking thing. So you start to affect commerce and business when, as a country, you play these little political games with everything. And I'm gonna stop my speech there.
I have a question about journal entries. Is there any is there any particular order that one should approach this? Like, does one do the revenue related ones first before the balance sheet ones, or the expenses? I mean, in a normal thing, maybe you would take the accounts by the order of the general ledger number, the account number that's assigned. But so for the CPA exam, as long as you get the journal entries right, they don't care which ones you did first. Like, I could have done the COGS and the inventory before the unearned revenue and the revenue one. It wouldn't matter, right?
Correct. I mean, let me be very specific here. Journal entries are recorded in the journal chronologically.
Okay.
Right. Once you have reported them as you're reporting them in the journal, the answer to your question is no. You got to do them chronologically, but no, you could go either direction. I mean, the reality is that many routine journal entries, I agree with some folks, are automated. The system just makes the journal entry because it's a sale. and they know the cash came, and the system can make the journal entry that way. You know, but my point in defense of journal entries is, well, yeah, but there are some journal entries that are somewhat specialized that you really need a CPA and accountant to really take a good look at that and understand how that should be reflected in the accounting system. And some frickin' buddy's got to figure that out. It's not going to be Arnold Schwarzenegger coming and say, oh, okay, well, this is a time. Let me tell you the journal entry here. And I'm a computer and I'm going to tell you everything about what the journal entry is. No, somebody's got to understand how that gets reflected and how that is supposed to be reflected in the financial statements, and then indicate somehow. If they want to turn it to an automated journal entry after that, that's fine. But somebody's got to figure this out first.
Okay.
So that's why they're relevant and why it's important that, you know, when you see questions with debits, and I think the examiners understand that. And so when you see questions like this, make the whole set of journal entries. Trust me, you'll save more time than you'll waste.
Got it. Thank you.
And thank you for that. I'll be one of the people that admits I kind of tuned out the journal entries because of that. Like, oh, when we get to the real world, it's automated, but that makes sense.
I mean, I had a associate, a former student of mine who's getting ready to be a partner in one of the CPA firms. And he told me, well, I don't care if students know journal entries. And I'm like, bullshit. You say that because they know the journal, because I send you students who know how to do journal entries. Don't tell me you don't care. Because if you got somebody in here and couldn't tell you to increase an asset, increase a liability, you immediately, you know, start coming back and say, why don't you teach student journal entries?
Yeah, how would you audit?
Huh?
How would you audit if you don't know journal entries?
Yeah, I mean, you've got to understand how things are supposed to be reflected in the financial statements, and it happens, you know, through journal entries. Come on.
You can't
And
do
how would you
month-end
spot
close.
fraud?
Huh?
I said,
What'd
and
you
how
say?
would you spot fraud, which is part of auditing?
Yeah. What'd you say, Donald?
I said, you use journal entries to do closes, like month-end close, quarter-end closes, year-end closes. They're pretty, like, actually important. I don't know how you could be an accountant and not use them.
Yeah, and it's not like, you know, accounts mysteriously magically appear on the financial statements. There was a journal entry behind that. And if there's something wrong with the journal entry, like you're saying, then I have to know how to fix that with another correcting journal entry. Anyway, I'll stop. I think I've got a class of converts. Okay. All right, guys, I'm stopping there, obviously, because I want you to get a nice, good, crisp feel for getting through modules 1, 2, and 3. I think we picked up a lot of information here. We'll pick up with module 4 on Thursday. Do your best to get those first 3 modules done, because this thing starts to roll on you pretty quickly if you start to fall behind on these homework assignments, and all of a sudden you've got this daunting mountain of homework to get through, and that's where we start to see problems. Okay. All right, guys, and I think Sharada, you had a question, but other than that, if there's nothing else, we will adjourn things.
Thank you. Have a good evening.
Okay, guys. I'm going to stop the recording.
Thank
And
you.
I'll
And I
post
found
that
out
up.
why I don't have my score yet.
Why?
Because I took